Some stories disappear, some are erased, and some are waiting to be uncovered. The Dark Bureau.
Each day, the world's trade pulses through ports whose names change quietly in the dim hours before dawn. Deals are signed, contracts notarized, funds transferred. Every transaction looks public and legal. Banks in London and Singapore process payments, local officials cut ribbons, and investors herald foreign capital as progress. But in the background, the decisive moves start long before any paperwork is filed. Unnamed fund managers working behind glass doors in distant cities orchestrate the final outcomes. Assets pass through a web of shell companies and proxy directors. All on paper, the owners are new. In substance, command has simply shifted hands, often toward Beijing, far from any local authority. To outsiders, these takeovers look like the workings of global capitalism. Investment brings jobs, trade, infrastructure. For ministers and executives at negotiation tables, they mean growth, promises to voters, and economic lifelines. But beneath the surface, a riddle persists. If decisions appear domestic, why does real leverage lie abroad? Who truly wields power when every signature and company record threads back to vast, hidden networks converging inside China's state apparatus? Step outside the headlines and patterns become clear. From tech startups in Germany to electric grids in southern Africa or newly privatised European ports, the same techniques recur. Offshore holding companies in tax havens from the Caribbean to Luxembourg mask true ownership. Joint ventures and minority stakes confuse accountability, making it nearly impossible to pinpoint who pulls the strings. Diligent investigators and financial reporters follow the paper trail, time and again finding state-connected directors, policy banks in Beijing, and Communist Party officials quietly involved. The architecture is complex by design. No single puppet master, but a system fine-tuned over decades for plausible deniability and persistent influence. Originally, China's global expansion marched openly. State-owned giants bought raw materials and strategic outposts to support the country's manufacturing boom. Over the last decade, the playbook has evolved. Instead of direct control, a maze of funds, offshore firms and nominee directors now blurs who benefits and decides. Some entities are empty shells, others hire locals, run PR campaigns or host policy forums. But wherever you look closely, be it a port, oil field or tech hub, ownership charts reveal shared features, recurring directors with party links, lending lines from Chinese policy banks, and contracted obligations buried in fine print. Where foreign law limits Chinese investment, new proxies appear to mask the Beijing connection. If allies need support, capital flows in. If critics demand transparency or refuse a deal, projects quietly freeze, funding disappears, or rival bids emerge, always with new frontmen but familiar interests. The system has a dual purpose. It mimics ordinary competition and profit-seeking, but its real advantage is quiet, adaptable leverage. If lawmakers move to block an investment, the structure morphs. New subsidiaries, new deals, and always compliant paperwork. Through sponsorships, research partnerships, or media buys, influence spreads, ensuring future decisions align with long-term strategic goals. This hidden circuit, profit and policy working in tandem, complicates regulatory oversight everywhere. When opposition arises, the network responds, shifting personnel, creating new legal entities, or rerouting investments to bypass scrutiny. China's model is less about outright ownership than about operational control and the ability to direct outcomes discreetly. Across Europe and Africa, officials struggle to draw the line between commercial activity and orchestrated foreign leverage. Screening mechanisms appear. Regulators scrutinise sources of funding and company control, hoping to spot state-backed actors. In Africa, the choice is even starker. Accept transformative infrastructure with strings attached or risk being left behind. As investment networks grow dense and opaque, the difference between local and foreign-backed actors grows harder to discern. Is the local partner really local, or just a face for remote priorities? The investigative race is relentless. Newsrooms and public agencies share data and pursue leaks, memos from Chinese ministries, party cadre staff rosters, spreadsheets showing who finances what. Probes expose how opaque capital wins contracts for African railways or southern European ports. Company boards fill with party officials, diplomats, or recurring directors, shuffled strategically. When an old proxy faces scrutiny, a newer, cleaner-appearing entity emerges, keeping the control structure intact. The model doesn't just resist disruption, it adapts, learning from each regulatory intervention to become harder to track. Complexity is a weapon. When a European country introduces stricter investment screening, alignments shift instantly. A local equity fund, seemingly private, shares senior managers with Chinese state banks. A new joint venture quietly markets itself as an independent vehicle, while policy loans guarantee its stability. Each time compliance systems catch up, legal structures and players shift. The network's ability to outpace scrutiny is its insurance policy. Funds close, companies dissolve, aliases appear, always 2 steps ahead of oversight. Institutions fight back. Due diligence teams at major European banks run artificial intelligence software to map links to foreign states. African governments hire expensive consultants to probe loan terms and infrastructure agreements. Still, the heart of the issue is not technical, but systemic. Contract terms are written to transfer operational control when risk events are triggered. Information sharing requirements masquerade as regulatory compliance, but plant seeds of strategic dependency. Debt covenants allow foreign agents, ultimately Chinese state banks, to seize or redirect assets in times of crisis. Watchdogs raise flags, committees debate security risks, but genuine transparency always recedes. Rapidly shifting networks and immense flows of global capital cloud the realities of who is in command. The effects ripple far past economics. When European or African universities enter R&D deals with Chinese institutes, clauses quietly mandate data and technology transfers. Upgraded grids, railways and networks look locally controlled but deliver insights, value and influence to distant headquarters. Even public narratives adjust. Political leaders praise new partnerships, while the subtler costs to sovereignty are seldom discussed openly, surfacing only when leverage is exerted. Funding disappears, loans stall, deadlines slip, pressure brought to bear obliquely but effectively, conditioning future decisions. This shadow command tangibly alters politics and society. Legislative votes in Africa and Europe often align more with dependency charts than political manifestos. Resistors are quietly isolated, while rivals suddenly enjoy a surge of local investment, which on closer inspection comes from offshore proxies with indirect ties to Beijing. Debates about smart grids, 5G or cyber policy get stuck between warnings of foreign dependency and boosterish visions of growth, even as facts about ownership and direction remain shrouded by legal complexity. Over time, national agency narrows. The levers of technology, policy and trade respond more to implicit guidance from abroad than to open deliberation at home. The psychological effect is subtle but decisive. For those overseeing projects, civil servants, board members, even local CEOs, unspoken boundaries and silent signals suffuse the atmosphere. Every deal is shadowed by implicit instructions. Every stalled negotiation echoes silent vetoes. As responsibilities disperse through off-the-books channels, public oversight ends up monitoring only outward appearances, The new logo, the improved trains, never the invisible criteria that determine why some outcomes always favour remote interests. Take a concrete example. In 2018, an African railway changed hands 3 times in 2 years. Each buyer appeared unrelated, yet journalists working with leaked audits followed the sequence of shell companies back to a single Beijing investment entity. By 2022, Chinese financing had become a hidden force in nearly half the ownership layers of certain European grid operators. Most citizens remained unaware, but for policymakers, the reality is clear. When exposure in one market compels retreat, the same interests reappear elsewhere with a fresh identity. The core blueprint is built to withstand any single shock, its logic and command structure always preserved. The pattern extends beyond physical infrastructure. Academic collaborations, internet backbone providers, cloud storage election systems, all are increasingly caught in the same web of indirect dependency. Regulators respond with cross-border committees, new policies, and advisory lists. NGOs rank levels of influence, urging better transparency. And yet, for each exposed front, a new hybrid appears, local enough to pass muster, sophisticated enough to hide its affiliations. Media campaigns declare the projects national, and legal teams engineer compliant paperwork just ahead of the latest regulation. The real architecture is labyrinthine by intent. Every layer of shell companies and nominees is made to be discarded and rebuilt as needed. No single exposure truly weakens the core. Governments and regulators often find themselves in a reactive posture, pursuing old leads even as new dependencies form quietly elsewhere. As each entry point closes, new agents emerge, relabeling the strategy, always privately coordinated from afar. The system endures by minimising points of failure. Its strength comes from commercial flexibility fused with single-minded state ambition. It fragments, reforms, and adapts at will. What the public sees is a new investor and a ribbon cutting, but officials learn to interpret the codes, calculating how much latitude has already vanished, which decisions have quietly slipped beyond their grasp. When a crisis erupts, trade sanctions, a lawsuit, a diplomatic spat, the usually invisible command is suddenly felt in delayed shipments, disrupted data, lost financing. By then, the options are already constrained. Beyond compliance and financial reporting, true transparency is a matter of sovereignty over institutions, technologies, and values. As costs and dependencies crystallise, every project, law, and alliance becomes a test of how much real choice remains. Behind each local company or celebrated partnership is a system advancing discreetly, its greatest power residing in constant legal adaptation and plausible deniability. In the end, the true price is measured not just by balance sheets, but by what choices a country can no longer make on its own. That is the contest now underway, not in courtrooms or at public hearings, but in day-to-day strategies and trade-offs by those who manage essential infrastructure and policies. The network's quiet resilience is its warning, a reminder that beneath every transaction and partnership, the question lingers, demanding answer. Who, in reality, is commanding the future from the shadows?